Preparing for an intact financial interview questions and answers interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work at Intact Financial? I want to join Intact because it combines scale with a strong underwriting culture and a clear customer focus. I am particularly interested in how the company uses data, technology, and disciplined risk selection to improve insurance outcomes across personal, commercial, and specialty lines. My analytical background would let me contribute to performance reporting and decision-making, while Intact's breadth would help me build a deeper understanding of the insurance value chain. While answering, connect Intact's Canadian leadership, specialty insurance expertise, customer focus, disciplined underwriting, and long-term growth strategy to your own skills, motivation, and interest in insurance. Question 2. What do you know about Intact Financial's business? Intact is a major property and casualty insurer, with businesses spanning personal insurance, commercial insurance, and specialty lines. It earns premiums by assuming risks, pays claims and operating expenses, and invests the funds held between collection and settlement. Its economics therefore depend on both underwriting performance and investment income. I would also mention its scale, broker relationships, data capabilities, and emphasis on sustainable profitability rather than premium growth alone. Make sure to cover Intact's property and casualty insurance model, personal and commercial lines, Canadian and international operations, premiums, claims, investment income, and the importance of underwriting profitability. Question 3. Can you explain how a property and casualty insurer makes money? A P&C insurer collects premiums upfront, assumes policyholder risk, and later pays eligible claims and operating costs. Underwriting profit equals earned premiums less claims and expenses, while investment income is generated on the capital and policyholder funds held temporarily. A combined ratio below 100% indicates underwriting profitability. Results can be volatile because pricing, inflation, claims severity, reserving assumptions, and catastrophe events all influence the final outcome. In your answer, talk about written and earned premiums, claims, expenses, investment income, the underwriting result, combined ratio, pricing adequacy, and the effect of catastrophe losses. Question 4. What is the difference between written premium and earned premium? Written premium is the premium recorded when a policy is issued or renewed, whereas earned premium reflects the portion of coverage already provided. For example, if a customer pays $1,200 for 12 months, approximately $100 is earned each month, assuming straight-line recognition. The remaining amount is unearned premium, a liability for future coverage. This distinction matters because current underwriting results should match revenue with the risk period. Be sure to mention that written premium reflects policy issuance, earned premium recognizes coverage over time, unearned premium is deferred, and timing differences affect revenue, profitability, and performance analysis. Question 5. How would you calculate and interpret the combined ratio? The combined ratio equals the loss ratio plus the expense ratio, or incurred claims and adjustment expenses plus underwriting expenses divided by earned premium. A 95% ratio means the insurer generates $5 of underwriting profit per $100 of earned premium, before investment income. I would analyze the trend, separate catastrophe from underlying losses, and investigate reserve development, pricing, claims inflation, and expense changes before drawing conclusions. Focus on the loss ratio, expense ratio, formula, interpretation above or below 100%, catastrophe effects, reserve development, and why trends are more informative than one isolated period. Question 6. What is the difference between loss ratio and expense ratio? The loss ratio measures incurred claims and related adjustment expenses as a percentage of earned premium. The expense ratio measures underwriting, acquisition, and operating expenses relative to earned premium. Together they form the combined ratio. A rising loss ratio may indicate inadequate pricing, higher severity, or adverse reserving, while a rising expense ratio may reflect inflation, commissions, technology investment, or inefficiency. I would assess both separately before recommending action. Make sure to distinguish claims costs from operating and acquisition costs, explain each denominator, connect both ratios to the combined ratio, and identify operational drivers management can influence. Question 7. How would rising inflation affect Intact's insurance results? Inflation can increase claims severity because vehicle parts, construction materials, labor, and medical services become more expensive. It can also raise operating expenses and require stronger reserves for unpaid claims. If premiums do not reprice quickly enough, the loss ratio and combined ratio deteriorate. Higher interest rates may support investment income, but that benefit does not immediately offset underwriting pressure. I would monitor exposure trends, rate adequacy, and reserve assumptions together. In your answer, cover claims severity, repair and replacement costs, bodily injury, pricing lag, reserves, expense inflation, investment yields, and the need to distinguish short-term pressure from longer-term repricing. Question 8. What is insurance reserving, and why is it important? Reserving is the process of estimating the ultimate cost of claims that have occurred, including amounts not yet reported or fully settled. Case reserves cover known claims, while IBNR addresses expected but unreported or underdeveloped claims. Because the final cost is uncertain, actuaries use historical patterns, exposure data, and judgment. Inadequate reserves can overstate earnings and capital, while excessive reserves suppress current profit and later create favorable development. Be sure to mention case reserves, incurred but not reported claims, ultimate losses, actuarial judgment, reserve development, earnings volatility, and the balance sheet importance of unpaid claims liabilities. Question 9. How would you evaluate whether an insurer is adequately pricing risk? I would compare expected claims and expenses with the premium required to achieve a target combined ratio and return on capital. The analysis should reflect exposure mix, severity trends, inflation, reinsurance, retention, and investment assumptions. I would review rate indications by segment rather than relying on an average portfolio number. Finally, I would compare actual loss emergence with prior expectations, because pricing adequacy is validated through subsequent experience. Focus on expected loss costs, expenses, target profit, rate indications, exposure changes, segmentation, retention, competitive conditions, and actual versus expected performance after policies mature. Question 10. What are the main differences between personal and commercial insurance? Personal insurance generally covers standardized risks such as homes and vehicles, allowing significant use of automated pricing and large historical datasets. Commercial insurance covers businesses with more varied exposures, larger limits, customized terms, and greater underwriting judgment. Commercial policies may involve property, liability, cyber, or specialty risks, often distributed through brokers. The trade-off is greater complexity, but disciplined specialization can produce attractive risk-adjusted returns. In your answer, contrast customer size, underwriting complexity, policy customization, data availability, distribution, claims characteristics, pricing cycles, and the role of broker relationships in commercial insurance. Question 11. How do catastrophe events affect an insurer's financial statements? A catastrophe typically increases incurred claims and claim liabilities immediately, reducing underwriting profit and potentially creating a net loss for the period. Reinsurance can recover part of the gross cost, so I would distinguish gross, ceded, and net losses. Capital may also be pressured if claims payments are large or investments must be sold. I would assess event estimates, reserve uncertainty, recoverables, and whether the impact changes future pricing. Mention higher incurred claims, reinsurance recoveries, earnings volatility, reserves, capital pressure, investment liquidation risk, disclosure requirements, and the difference between gross and net catastrophe losses. Question 12. What role does reinsurance play in Intact's business? Reinsurance transfers part of an insurer's risk to another insurer, helping protect capital and earnings from large or concentrated losses. Quota share arrangements transfer a proportion of premiums and losses, while excessive loss coverage responds above a defined threshold, often for catastrophe risk. Reinsurance can improve capacity and stabilize results, but it has a cost and introduces counterparty and recoverable risk. I would evaluate protection based on net exposure and capital objectives. Make sure to explain risk transfer, catastrophe protection, capacity, volatility reduction, quota share versus excessive loss structures, ceded premium, recoverables, and counterparty credit risk. Question 13. Can you explain International Financial Reporting Standards 17 at a high level? International Financial Reporting Standards 17 measures insurance contracts using expected future cash flows, a risk adjustment, and, where applicable, a contractual service margin representing unearned profit. Profit is generally recognized as insurance service is provided rather than entirely at inception. The standard separates insurance service results from insurance finance effects and requires extensive disclosures. For a P&C insurer, I would understand how claims patterns, discounting, and short-duration approaches affect reported performance. Focus on insurance contract liabilities, fulfillment cash flows, contractual service margin, risk adjustment, revenue recognition as service is provided, and why International Financial Reporting Standards 17 improves comparability and transparency. Question 14. How would higher interest rates affect Intact Financial? Higher rates can improve future investment income as maturing assets are reinvested at better yields. However, existing fixed income securities generally decline in market value, and the impact depends on accounting classification, duration, and capital rules. Higher discount rates may reduce the present value of certain liabilities, partly offsetting asset declines. I would therefore analyze asset liability duration, cash flow matching, realized versus unrealized results, and the regulatory capital effect. Be sure to mention reinvestment income, bond portfolio valuations, discount rates for liabilities, duration matching, unrealized gains or losses, capital impacts, and the timing difference between benefits and valuation pressure. Question 15. What financial metrics would you monitor for an insurer? I would monitor written and earned premium growth, renewal and retention, the combined ratio, underlying loss ratio, expense ratio, and catastrophe-adjusted performance. I would also review reserve development, operating return on equity, investment income, capital adequacy, and reinsurance recoverables. Metrics should be segmented by line, geography, and distribution channel. Growth is attractive only when it is adequately priced, so I would link volume trends to profitability and risk-adjusted returns. In your answer, include premiums growth, combined ratio, loss and expense ratios, reserve development, operating return, investment income, capital adequacy, retention, and customer or claims indicators. Question 16. Tell me about a time you found an error in financial analysis. In a monthly reporting file, I noticed that one business unit's expense ratio had moved sharply despite stable activity. I traced the change to a duplicated lookup range that assigned several invoices twice. I corrected the formula, reconciled the total to the ledger, and documented a check comparing source records with reported outputs. I then explained the issue and impact to my manager promptly. The experience reinforced that reasonableness checks are essential. While answering, use a concise star structure, explain how you identified the issue, quantify its effect if possible, describe your correction and controls, and emphasize ownership and communication. Question 17. How would you explain a complex insurance result to a non-finance stakeholder? I would start with the business conclusion, then explain the 2 or 3 drivers that matter most. For example, instead of saying the loss ratio deteriorated due to severity, I would say average repair costs rose faster than premiums, reducing profit on each policy. I would use a simple chart, separate facts from assumptions, and finish with the action required. I would invite questions and confirm the stakeholder's interpretation. Make sure to cover audience awareness, plain language, a simple example, the key business driver, visual support, implications, and confirmation that the stakeholder understands the decision required. Question 18. How would you prioritize competing deadlines during a busy reporting period? I would first list each deliverable, deadline, stakeholder, dependency, and potential business impact. Regulatory and externally reported items would receive priority, followed by tasks blocking other teams. I would break large work into checkpoints, communicate conflicts early, and agree on trade-offs rather than silently missing a deadline. Even under pressure, I would preserve core reconciliations and review controls. That approach balances speed, transparency, and reporting reliability. Be sure to mention materiality, regulatory and management deadlines, dependencies, effort estimates, communication, escalation, quality controls, and the importance of protecting accuracy under pressure. Question 19. How would you assess a proposed investment in insurance technology? I would evaluate the investment through both financial and operational lenses. Benefits might include lower claims leakage, faster settlement, improved fraud detection, better retention, or reduced manual work. I would build a business case with implementation costs, recurring expenses, timing, adoption assumptions, and sensitivity scenarios. I would also assess cybersecurity, data quality, regulatory, and execution risks. A positive ROI is not enough if controls or customer outcomes deteriorate. Focus on strategic fit, customer and claims benefits, implementation cost, productivity, loss ratio impact, payback, risks, adoption, data quality, and scenario analysis rather than relying only on headline ROI. Question 20. Why should Intact hire you? Intact should hire me because I combine careful financial analysis with practical communication and strong ownership. I am comfortable working with detailed data, reconciling inconsistencies, and explaining what the numbers mean for business decisions. In previous work, I improved a recurring report by automating checks and reducing review time while preserving accuracy. I would bring that discipline to insurance reporting, learn quickly from experienced colleagues, and contribute reliably during demanding periods. In your answer, connect relevant analytical and communication skills to insurance economics, demonstrate accuracy and ownership, give one evidence-based example, and show enthusiasm for learning Intact's business. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.